Welcome to the Exit Rich podcast, where the leading authority on buying, selling, fixing, and growing companies, Michelle Seiler Tucker, is dedicated to helping you find the path to retire rich and move on to your next adventure by exiting your business for the desired dream price you deserve. Get ready to exit rich with your host, Michelle Seiler Tucker.
I'm so excited to have a very special guest on today, Mr. Hall Martin. So Mr. Hall Martin is really going to talk about investment capital and funding startups, and something that all of you have been asking me about. So that's why I decided to have him on the show today. All right, so let me read a little bit about Mr. Hall. I'll tell you a little bit about him. Mr. Hall Martin is the founder and CEO of 10 Capital and host of Investor Connect podcast, which I'm going to be on. And his firm, and so Connect podcast program, he launched the firm as the Texas Entrepreneur Networks in 2009. Today, 10 Capital has over 15,000 investors. My God, that's a lot of investors. And then 10 Capital, so 10 Capital is very successful, raised over 900 million. Is that accurate?
That's right. Since 2009, we've helped people raise over $900 million, and it continues to grow.
And you also have a nonprofit.
That's right. It's for entrepreneur and investor education about funding and investing.
Awesome. And Mr. Martin also serves as an adjunct professor for the University of Texas, leading the idea to IP programs, which foster startups from the engineering program. So there's a lot to unpack there, Mr. Martin.
We've been busy.
Get started. What is your background? How did you get started doing this?
Well, great. Yeah. So I moved to Austin in 1986, back when there were about 400,000 people in town. Now there's over 2 million. So it's seen a tremendous amount of growth. And I came here for graduate school and afterwards went to work for a company that later went IPO. When they went IPO in 95, I started doing angel investing. And we had an angel network here in Austin called the Capital Network, and it ran from 95 to 2002. And made an investment, lost all my money, started to realize that this is harder than it looks, but it was very interesting to do anyway.
I'm not the only one that's lost money then.
Not by a long shot. If this is part of the startup world, it's a risky thing and you will lose money. So that's for sure. But one thing about entrepreneurship is it is one of the only investments you'll ever make that is truly unlimited on the upside. Real estate, oil and gas, everything else has defined limits, but entrepreneurship does not. And so it can be very attractive. And so I was still very fascinated with it. I'm an early stage guy. And so when the company went public, I started doing angel investing. And when that network went away in 2002, I just started investing by myself and saw the challenge that is with angel investing by yourself. You spend all day finding the deals and you spend all night doing the diligence on them. And it's just really tough. And I really wanted to work with a group. And so in 2006, the city did a restart of our angel network and they called it the Central Texas Angel Network. And I was the first member to sign up for it. And when you're the first member to sign up in an angel network, you're automatically on the board in charge of membership. And it's a great honor. So no pay, but it's a great honor. That's right. So I did that for about 6 months and I recruited about 50 members, and then we lost our director. So I became the executive director and I ran it for about two years, and we got about 5 million invested in about 20 deals. And we ended up 10 years later with about a 40x return on that $5 million because we had.
Okay, I want you to stop right there. Pause.
Oh, sure.
40x. How significant is that? That's huge.
It's 40x, not 40%. I have to tell people that sometimes, but
it's still 40x. I get it. It's 40x.
So we had two home runs out of it at around 40 each, and it completely dwarfed everything else that was in the fund, and it had the usual returns. 25% of the deals had a positive return, 75% did not. So there's a lot of deals that didn't make it, but the two of the 25% did, really made a big difference. But that propelled the group onward. And then my undergraduate university, Baylor, came to me and said, well, we want an angel network out of the Alumni Association for Student Education. And so I helped him put that together, and I'm still a member there today. And then I had a county north of Austin called Williamson County wanting an angel network, and we called it the Wilco Angel Network. And it was mostly Sun City retirees that wanted to invest for some cash flow. But it was a lot of fun. And then in 2009, I decided, well, I'm tired of this big company living. I really want to get back to the early stage, and was having more fun doing the angel work than working at the big company. So I left and started what was called Texas Entrepreneurs Network. And we saw the challenge that startups had in raising funding. They needed help with the documents, you needed to learn how to pitch, and most importantly, they needed to learn how to follow up. Call the investor back. They're not going to just write you a check on the first call. And so we started the company, and we started helping companies around Texas up until about 2016, at which point we were getting calls from outside of Texas saying, hey, I've talked to everybody in Seattle. Now, where do I go to now? And so we had expanded our network nationally for investors before. And so we had about 5,000 investors at that point. And so we changed the name to 10 Capital and started working around the US instead of just around Texas. And have just been growing ever since.
Well, that's quite the story.
It's been quite a journey.
You have an incubator program, right? Don't you have an incubator?
I've helped start several incubator programs. In 2013, a local law firm came to me and said, hey, I want to do something for the city of Austin. And we looked around for the startup scene, and we looked around, and all the tech things seemed to be well taken care of. There was lots of incubators and co-working spaces. But I remember back from my days at C10 that half the investments in the first year were in consumer product goods, and looked around and nobody was doing anything for CPG. And so we said, well, let's do something on CPG. And that turned out to be the right move. We're here in the same city as Whole Foods headquarters.
Explain what CPG is.
Consumer product goods.
Because not everybody knows what that stands for.
Right. And so it's food and beverage, health and wellness.
You're like me talking about EBITDA.
Oh, I see. Yeah. So it's buying things at the grocery store. And in here in town, we have Whole Foods, and we had a lot of startups come to Austin because they wanted to get into Whole Foods and other distribution outlets. And at heart, we started an accelerator called SKU. It was originally called Incubation Station, but we were mostly rebranding and repackaging the startups so that they could be successful on the shelf at the brick and mortar stores. And then we would introduce them to the brokers and dealers that were specific to their sector. If you want to be in Trader Joe's on the West Coast, you have to talk to this guy. If you want to be in Aldi's in the Northeast, you have to be talking to this other group over here. And we were helping them with that. So we started an accelerator, and it did very well. Today, they're in 5 cities around the country. They do 35 deals every year. And it continues to grow and go from there. Awesome. But it was just timing, being at the right place at the right time was really key part of it for sure.
Well, I always say that's the most important thing in business, being at the right place at the right time. And of course, all the other ingredients. So are you familiar with the incubator that Perry Belcher has and Ryan Dice, who are in Austin? I'm pretty sure.
No, which incubator is that?
I don't know. It's a big incubator. They have a huge mastermind. It's Ryan Dice, Perry Belcher in Austin, Texas. I just wonder if you had any association with them.
Well, there's many of them now. When I started in 2009, there were two accelerators in town. Today, there's probably 50.
Oh, they've been around forever. I used to speak with them on stage. They've been around forever. So let's move on into some questions that our listeners would want to know information about. So what % of startups receive funding from angel or venture capitalists?
It's about 15%. It's not a big number. It's a small number. But that's angels, VCs, family offices, and family and friends. So there's a good number that receive funding.
Why is the number so small? Because a lot of businesses go out of business because they're undercapitalized. So why is the number so small? Why just 15%, do you think?
I think one reason is people haven't really thought through their business plan, and when I get pitches from half the pitches I get is just an idea. It's really not a business. And to raise money, you have to have a business. And you have to put some of your own money in. Not everybody wants to put their own money in. You have to go prove it works. You have to do what's called validation, market and product. The product works and people will pay for it. And it's just work. It's just a lot of work. And people start a business, but then realize, oh, this is more work than I thought it was. And they dropped out very quickly.
Well, that's also why 80% of businesses on the market will never sell, according to Steve Forbes, just because they don't have a business, they have a glorified job.
Well, they didn't build a business to sell. They built a business to just a need or desire or passion of some kind. But you have to think about selling a business to sell it, it has to meet certain criteria. You have to look at it from an investor's point of view, not the entrepreneur's passion point of view. It has to have a return on invested capital. It has to have, cash flow. It has, if you have recurring revenue and other things, that makes that a lot easier to achieve.
Well, you also got to have people in place. The business has to be able to run without you. You have to be in a thriving industry, not a dying one. You got to have all your processes buttoned up. You have to have proprietary trademarks, patents, databases, contracts, etc., and patrons and profits. That's the 6 P's in my book, Exit Rich.
Well, I will say that not everybody starts a business to sell it. They start the business to keep it. And so
I will say that that's the wrong mistake. And I don't want to get in a debate here with you on I've been doing this 22 years, but that's a big mistake, because here's what happens. They start a business to keep it. Then they die. They have a heart attack. I just had a lady coming from Dallas, Texas. Husband died from a heart attack like that. Left him with a mountain of debt and wanted to know if I could sell the business. It was him, subcontractors. When he died, everything died. So everybody should go into business with the mindset of selling the business. So at least you have a more profitable business, a sustainable business, a scalable business. And if you do, or you're diagnosed with cancer or some catastrophic event occurs, you set your family up for success, not for failure.
Right. And you see that a lot with generational transfers. Boomers are aging out. They want to pass it to their kids. The kids don't want it. Now what?
The kids don't want it. The kids want to go out and work with you and work on their masterpiece. They want to go. First of all, they've seen how much work the business owners put into the business, baby boomers especially, and how they don't take vacations, how they don't show up for their soccer games, baseball games, anything else, and then the kids are like, we don't want this business. And like I said, they want to go out and create their own masterpiece. I think less than 15% are even transferred anymore.
A lot of them are not. We get into some revenue-based funding tools to help transfer it to someone else, although typically not a family member. If the business has been around for 50 years, it's not in a sexy growing industry anymore. It's in something else. And so, but it was somebody's passion at one point. It was probably a good return for that person, but that's all it was. It wasn't anything more. But that's a good point.
So what do you require from startups? I assume you require a deck, right?
So we look for a pitch deck that tells their story. And what we're looking for is we want the company to be in the market, able to sell their product. And you don't have to have a lot of revenue, but you need to have some. You look for validation at the very early stages. The product works and people will pay for it. And you look for evidence of that. And many people come to me without that evidence. And I say, well, this is going to be very hard. We really should take the steps to go do that. Put a little bit of your own money in, go sell it to somebody.
Yeah, you want them to at least be in market and make some money, right? You don't want it to just be an idea that hasn't went to market yet.
Right. And I want to avoid the phrase, hey, we're going to market in 2 months, because that's the phrase of death, because investors have learned that 2 months could be 2 years and we really don't know when we're going to get there. Go get in the market, sell something, and then say, I am in the market. I can sell my product. And then you move on to the next level, which is where we want to work with people.
So, do you ever invest in companies that are pre-market?
We have in the past, but it's just very hard. And like I say, I think you should really get out and test your product in a bigger way. I'm amazed how many people come to me saying, oh, we haven't talked to any customers yet, but we're halfway through building it. And I just wonder how much you're not building it right because you haven't talked to any customers. And I always coach people, the first thing you should do is talk to a customer, not build a product. And my rule is sell it first, build it second. If you can't sell it in the first place, you don't have to build it in the second place.
You sound like Kevin Harrington right now.
Well, I think anybody that's been out there long enough kind of sees these rules. We're not the only ones saying this. And it's just, you just see a lot of failed businesses and you go back and we should have talked to more customers. And the other, when you go to raise funding from investors, that's what you take to the investor is what the customer is telling you. We talked to IBM and they have this problem. We've talked to IBM and they want us to put a pilot project together. We talked to IBM and they gave us $150K to go do a pilot project. This is the story you want to tell investors versus I had this idea, I'm going to build this product and I'm going to sell it to somebody someday. I don't know how. And that's not the story you want to tell to the investor.
Right. That's what we call field of dreams mentality. Build it and they will come. The field of dreamers, the dreamers. And, I also say, not just a product, before you start your widget, but also the processes. You should really talk to your customers to find out, what do they want to experience when they do business with your company? Because you should always base your processes on the customer's experience, not your own agenda. Like doctor's offices, the whole medical industry needs to be revamped. They need to change their processes and their hours with the patient's experience in mind when we can show up.
Yeah.
Okay, that's good to know. And then do you invest yourself or are you finding investors?
I do both. I invest myself, and then I also find investors for startups. Now, my investment is done on what I call a 3X and 3. One of the challenges in early stage funding is 2 out of 10 deals, the startup world, and this is proven all over the years, is 1 out of 10 is going to be a home run, be a big return. 1 out of 10 is going to go under. It's going to be dead, in a year or two. 2 or 3 are going to be what I call singles and doubles, a little bit of return, nice return there. And 5 are going to turn into lifestyle businesses, which means we're no longer on the equity path to sell to a venture buyer. We're now on the payroll path, which means we're just going to cash flow this out. And the 3 of us are just going to have a nice business here. Sorry, you're on the equity path, Mr. Investor. We're now on the payroll path. And I've done that enough times to know that, when they go on the payroll path, I want to go on there with them. And so a 3X and 3 is basically a convertible note with a redemption right at year 3 that says I get 3X my money and you pay me out. It turns into a revenue share agreement and basically just make room for me on the payroll with you where you are, and we'll just do it that way. Versus going on, foregoing the redemption right and converting to equity placement and going on the cap table and going out, because at year 3 it starts to become clear which way this is going. We're continuing to raise funding, grow the business, move up the curve, valuations going up, and that's where you want to be on the equity path. Or we're not raising funding. We aren't going to sell this like we thought we were in year 5. We're just going to keep it because, at heart, what somebody found is that if they just kept the business for 7 years, they'll make more money than if they sold it at year 7 because they have investors and others. So they just cash flow it out. And that's why I said, when I saw entrepreneurs moving on to the payroll track, I said, hey, I want to be on that plan. How do I get on that plan? And so that's how I came up with the redemption right at year 3. And there's no personal guarantee. If the business goes under, there's nothing back for anybody in that case. So if the business is up and running and growing, and I think it will continue, well, then I sign up for a 3X and 3 with the option.
Now, do you ever get involved are you on the board? Do you get involved with perhaps coaching the business owner, running the business? Are you ever involved in that standpoint? Are you just involved in investing money?
Typically, you're involved at some level. The saying among angel investors is you want to do a little good, make a little money, and have a little fun. And the do a little good is giving back to the startup and helping in some way, shape, and form, whatever you're doing. The make a little money is obvious there, and have a little fun means you've invested with a good group of people that you enjoy working with. And so those are the 3 criteria you look for to get into a deal.
Okay, awesome. Awesome. So how many deals have you invested in and how long have you been doing this for?
Well, I started in 2001 with that first one that went under, and then been in about 20, 30 deals ever since. I don't invest a lot, but when I invest, we try to help and be a part of it and so forth. And then, but number of companies we have helped raise funding is hundreds of companies have gone through here raising funding in the past.
So when you invest, so you don't really, the core competency is more raising the capital versus investing, right? Or that's what your sweet spot is.
Right. We're at heart, we're not running a fund. And I did that on purpose because I saw a lot of people go out, raise a fund, deploy it, have a good return, go raise another fund, deploy it. Oh, we didn't have a good return. We're done here. We're not raising any more money, or the market's not good. And so I wanted to get out of the boom and bust. And so I went into a model where I'm going to help startups raise funding, but we're not going to get into the fundraising mode. We're going to get into the helping them find funding and coaching, because I saw the need for that. People needed help with their documents, where to go look, how to pitch, and most importantly, how to follow up. I just saw people coming in pitching to my room full of angels. 90% would pitch, go away, and we would never hear from them again. And they got little or no money out of it. 10% of those guys, though, came back, gave us updates, reminders, told us more about it, and built a little bit of a relationship, and they raised most of the funding. That's the key. You have to go back and follow up and build a relationship with the investor.
With anything, follow up is key.
Absolutely. And, I always tell people, hey, write this down, and whoever you pitch to, go back, give them updates and so forth. And I think for the first 5 years I ran 10 Capital under the name Texas Entrepreneurs Network, I could count on one hand the number of people that actually did that. And so I said, well, I'm going to solve that problem. We're going to run the investor relations campaign for you, and we're going to help you tell your story back to those investors and help you raise funding. And then I found that if I became a broker, I would have to get a FINRA license, and then most of my angel networks and all my VCs would no longer talk to me or use my deals because they can't pay fees for the deal flow. So I went the non-broker route just because I wanted to keep my network that I built up in all those earlier years.
Who wants all that scrutiny?
That's a nice plus as well. No compliance and all the other stuff that goes with that.
So you're not raising the capital. You have a coaching program to help startups build their pitch deck, build their portfolio, build, follow up, etc. Okay, so you're coaching them. Okay, on the ones that you have invested in, do you have an exit strategy for those?
Well, I now have the 3X and 3 exit strategy, but back when I started, it was mostly just helping them find a path to sell. And, year 7 to 10, we're looking to help them sell the business. And that's when I discovered that a lot of these guys have figured out that they're going to make more money not selling the business. Eventually they would sell it, but you would get, they did not build a business that sold for a big amount. And that was one of the things I learned early on is people make very major decisions very casually sometimes. Oh, we're not going to put recurring revenue into this. This is too much work. Well, that's a 10x valuation we just threw away. Are we really sure we want to make that decision? And so that's where we got a lot into the coaching side of it, is making sure they understand the implications of these decisions when they make them.
And then the bottom line, the sweet spot is to really grow your EBITDA over $1 million, because that's where all the buyers are. And there's pretty high multiples for high EBITDA producing businesses, especially if they run on all 6 Ps, and especially if they have proprietary synergy assets. Because buyers will outbid other buyers for contracts and databases, celebrity endorsements, So that's where you get the biggest valuation. So how do you find the investors?
So I built a strong network of investors when I ran the angel groups, and then kept doing things with 10 Capital that put us back in front of investors, education sessions. We did a lot with content marketing. In our podcast program, we have what's called the Startup Funding Espresso. In the time it takes to drink an espresso, you can learn something about startup funding and raising. And these are short 2-minute podcasts. You can either read it or listen to it. And I've done over 600 of those. Is
that the one I'm coming on to talk about valuations?
No, that's the full podcast where you have the full discussion. But here I was breaking it down into smaller discussions because I saw people's attention continually shrinking down. And so I was trying to get something into a 2-minute window because I felt like that was the window I had of opportunity for somebody to read something. And if they saw the topic they were interested in, they could get it in 2 minutes. They would prefer that over buying a book off of Amazon or what have you, where I don't have time for that, but I have time for the espresso. And then we have the goal was to cover every topic in the startup world. And I think we have most of them covered right now. We're updating the website now so we can see the full panorama of them. But that was the idea, was to break it down into a granular fashion. I was also trying to repurpose the content. You create five espressos turn into an article, 10 espressos turn into a long article, 20 espressos are an e-guide. We're up to about 34 e-guides on our website right now. And so you can reuse content if you have it in a granular fashion like that.
Gotcha. Okay. So what is the most common mistakes that startups make when they start pitching to investors? Because we get people ready for Shark Tank. I belong to masterminds. I speak on a lot of stages. I've been on many Shark Tank panels where I'm the investor. So I can tell you all the I've heard and all the mistakes I've seen, but what have you heard and seen?
Well, the most common mistake in the novice one is they treat the investor like a customer. Let me tell you everything about this product. Let me tell you how it works and why you want to buy it.
They throw up on them.
Right. And so, but the product is just one step. We need to know about the team and the business model and all this other stuff. And so you have to balance it out a little bit. That's one thing, is to make sure that you're treating the investor as an investor, which is, I need to know holistically about the business and the good decisions that we have, and emphasize what the team is and so forth. So often they just show me a picture of 5 guys up there, but I have no idea who they are, what they've done in the past, and are they really the right guys? And
Rented them from Fiverr, Elance, or Odesk.
you don't know. And so you really want to make clear that you do have a rock star team. As the saying goes, it's the A team working on a B project. They're going to get this done.
What if they don't have that rock star team? They don't have that A team yet, but they have a really good, solid idea. They have started to they have went to market. They're building that team. They don't quite have that team yet, especially in today's economy and what's going on in the world. It's so hard to get good talent these days. But what if they don't have that team? Can they still go pitch? You recommend them not to pitch until they build that team?
Well, I recommend you get some advisors who will come in and stand in for a little bit of it. And at the seed and Series A level, you really don't need a team of 15 people. That's a problem the other way. Who's going to pay all these guys? Right.
Yeah.
You only need 1, 2, or 3 people. At the very early stage, you need someone building it, somebody selling it. No fair, we're all building it, nobody's selling it. So it's not a huge head count at the early stage. Mm-hmm. As you get up into the Series A, you need the designer, hacker, and hustler model. The designer is designing the product. The hacker is actually coding it and doing the heavy lifting behind it. And the hustler is out selling it and raising funding. And that model works very well at the Series A. And then as you go up from there, there's different things you need to do. But I find you really don't need huge numbers of people. What you need are a few good people and then just a lot of support beneath them to get their work done.
Now, do you coach all types of startups, or is it just specifically in the consumer goods?
Well, we cover all venture startups. And so half our deal flow is technology-enabled businesses, fintech, health tech, et cetera. 25% of the consumer product good, the food and beverage, the health and wellness, and 25% are in the healthcare, life science, biotech space, mostly digital health, a lot of that out there, and then some biotech, medical device, and diagnostics.
Okay, awesome. So how does a startup close the investor? You don't do the closing. You're primarily coaching, and you're bringing the investors to the table. Is that correct?
That's right. In the seed world, I come from the angel world, and basically a CEO goes out with a convertible note or a safe note, and they're basically convincing investors to put money in. And with the convertible note, the investor signs the note, and the investor signs a check, and the CEO signs the note. The money goes into the business the next day. When you get to Series A, you have to have an equity agreement, and you need a lead investor. So we're starting off building it with convertible notes, and then until we find the lead investor and we negotiate the valuation and the terms and so forth, then all those notes convert over into the price round. You just don't know when you're going to find that lead investor. They can be the first one in the door, the 5th or the 25th. And so we use convertible notes to pick up some money along the way, because that really helps close the lead investor. They show up and you've been raising for 3 months and nobody's put money in because you were waiting for a lead investor. It doesn't look good because there's no money in. What's wrong with this deal? On the other hand, if there's 300, 400, 500K that you've already picked up, oh, well, that's money I don't have to raise. There's support for this. Other people are in the deal. And so that's why I always like to start with convertible notes to get it rolling until we find the lead investor. And then now we move it into the next level and we take the business up the curve.
Gotcha. Okay. What's the most unique way you've seen someone really connect with investors? That was one of your questions.
The most unique ways connect with the investors.
Unique way.
Oh, I think the thing I found most fascinating once is when you're going into a space, you really should do some research on it. You should know the industry and what's going on. And I had a startup come to me saying, hey, I think they were in the fintech space. And they said, I've done an extensive, exhaustive analysis of the fintech space in the startup world today. There's 6 major segments, payments and FINRA and all this other stuff. And I like to share with you the results of my research and educate you on what's going on. Well, investors love to be educated, and there's no ask. And they're not asking me to invest or coach or advise. And so I went out to the coffee shop and they walked me through, and it was really fascinating what the current state of the industry was. Saw where the money was being raised, what was growing, how fast it was growing, how big the markets were, what the new segments were coming up, what the careabouts of the investors were and the startups and all the customers and all that. And so to meet investors, what I coach startups is go do some research and then offer them that research either in a long Zoom call or a coffee. But there's no other ask. You just go and build a relationship with that information. And then later, when they find out what you do, if there's interest and it's appropriate, you can then start to ask. But I thought the research was a great way to get into it, because at heart, you should be doing research on your industry anyway. Why not share that with other people to build your connections?
Yeah, and I think that's great advice, because I see too many people going in for the kill right away. You know, I belong to a lot of different masterminds, and I see somebody walk up to somebody right away and say, "We invest in my company." No rapport building. No, "Hi, how are you doing? What can I do for you?" I mean, I always tell them, get to know the person. Ask how you can help them first before you go ask them to invest money in your company.
That's right.
So, these are just common sense things. They're not common sense. It's not so common anymore.
Well, they're just all in a hurry to get there, and
they're all in a hurry to get there. And I got to slow down, because you could have the best investor in front of you right there at a mastermind, and you just killed the deal because of your approach.
Right.
So one of my other questions I had that flew out my brain, it just flew back in, is who's doing these evaluations? So when y'all go to an investor and you do evaluations, a lot of these are pre-revenue, right? Or they have very little revenue, maybe no net income, no EBITDA. Who's doing evaluations on these companies?
Well, so there's two answers to that question. One is that's one of the advantages of safe notes and convertible notes, is that you're technically not setting valuation. You do set a valuation cap, and as long as your numbers
when you go to Series A, you are.
Well, when you go to Series A, at some point, you're going to move from convertible note to setting the valuation. But I always tell people, valuation is not a formula. It's a negotiation. It's a back and forth. No matter what number you put out there, the other side is going to push back and say, well, how did you get to that? And so what you need to do is come up with all the value propositions in the deal to make your deal work. And so to justify the valuations. So if you've got a rock star team, you have to put that on the table and start assigning values. And to that end, I came up with a 4X model there for how you do valuations, which means you give yourself $1 million valuation for each of four things: the sales, the team, the product, and the IP, and go through and articulate all the values that are in there, add up all four, and that's ostensibly how much your company is worth at the very, very early stage. Later, you get into other aspects, but you can start to put on the table what is in the deal, because that's about the only thing that convinces investor.
You think Shark Tank would agree with that methodology?
No, they have other valuations. They've seen other deals out there.
$1 million for this and $1 million for that. They would never agree with that. I mean, most of the people get laughed off the stage at Shark Tank because, well, yeah, it's drama, right? But B, it's because most people go in there way overvaluating their company. Right.
And well, that's one thing you do with the 4X is you start to figure out what is in the deal today. And if it's not there, and that's the other mistake people make, is they want tomorrow's valuation today. Well, no, you get today's valuation for today, and tomorrow you get tomorrow's.
That. That's not just startups. That's existing businesses. Right. You know what existing businesses want? They want their entire retirement fund to be the valuation. So if they think it's going to cost them $20 million to retire, boom, that's their valuation they want.
Right. Well, they'll say, well, another company in my field just raised money on a $25 million valuation. Therefore, I get $25 million too. Well, that other company is 5 years ahead of you. So in 5 years, you can ask for 25 million if you're at the same place, but you're not at the same place. You're back at the $5 million level. And so they want, the valuation that others have further along right now. And they don't understand why you have to give up money. Well, the investor's taking on risk. And today, if you want the money today, well, then you have to take today's valuation. If you want the money in 5 years, well, yeah, you can get the money then, but you want the money today. So that's why you have to have today's valuation for what's in the business today.
Yeah, they don't do that on Shark Tank. They go 3 years, 4 years, 5 years out.
Well, they're all prognosticating, putting it on the growth curve, and a lot of it's for dramatic TV effect as well. So
but I'm here to tell you, as somebody who's been in this business for a very long time, most business owners overvalue their business. Most business owners have been in business, not just startups. It's not just startups. Way over their value. I have people coming to me saying, I want 20 million and their EBITDA is 200,000. because that's what they need to retire on. That's what they need to send 5 girls to college and pay for 5 girls' weddings or buy an island.
That's
It's
that's
business
right.
owners too. Yeah, everybody seems to overvalue weight their business. I mean, business owners think their baby is prettier than everybody else's.
Absolutely. Absolutely. Everybody's way over there, which is why investors are automatically trying to pull that back down to reality.
Yeah. All right. Who is successful in raising funding?
I think the ones who are successful raising funding are the ones that convince the investor that what they're saying is true and it will happen. And I see that a lot with startups. They come in and they never want to talk about the current revenue. They only want to talk about the future revenue.
Mhm.
But as an investor, I need to know where you are today in order to draw a line from that to where you say you're going to go and then see if that's a realistic number. But if you can never tell me your current revenue, well, then my rule is it's zero. And it's not clear that you're going to be able to make that giant curve you're drawing there. And so the ones who raise money are the ones that convince the investor that what they're saying is inevitable. It is going to happen with or without you. It's going to happen. And that's the best way to approach it. I've had some startups go to investors say, without you, we will fail. Well, no investor wants all the weight of the deal on their own shoulders. They want to share that. They'll take a little bit, but they're not going to take all of it. And so you want to go to them and say, with or without you, we're going to raise this money. We're going to be successful in a nice way. And that's the kind of deal investors want to jump on, is they can be a part of something, but it's not going to weigh them down getting there as well. And you have to come up with where we are today and show how you can get to where you want to go and how that will be successful. And if you can convince people that they buy into that idea, well, then you have a successful fundraise. But they're not jumping into something they don't think is going to work.
As an investor, I don't think I would ever invest in somebody who says, I really need you, otherwise this deal will fall apart. Like, I won't be successful. I'll be like, okay, I'm running, run, Forrest, run. Sorry, how many startups that try to raise capital are actually successful at raising capital? I don't know, maybe you already answered that.
Well, it varies over time. I'd say
a good average.
I'd say about 25% actually raise funding. And then people come back and they realize, well, I'm not ready yet. I need to go get more prepared. They're asking me hard questions. And I ask them, well, what did they ask you? Well, they want to know how they can get their money back. And that was a hard question. And they were used to talking to family and friends who put money in because of the relationship, not because of the business. And as you draw the circle further away from family and friends, it's more and more about proving this. And they sometimes find they're really not ready for that. And then some people realize, oh boy, my business is really not ready for funding. It's not going to have those returns and do the things that everybody wants. And so they either change the idea to a lifestyle business or they go on to do something, or they change it to a venture business that can really stand up, because it is a very strong filter they put startups through. So it's one of the things that not everybody raises funding. Everybody wants to raise funding, but they don't realize how much work it really is until they actually get there.
Yeah, it's a tremendous amount of work. It's just like running just like building a business itself. It's a tremendous amount of work. If it was easy, everybody would be doing it. So how many investors? Now you have 15,000 investors, is that correct?
We've been curating investor. These are venture capital funds, angel groups, angel investors, syndicate funds, and we're getting a little bit more into crowdfunding. That's a good option for some people as well. Although those are more retail investors. The average investment on a crowdfunding campaign is $500. So it's another crowd to go to. We put that at the end of our program, not at the beginning. A lot of people start with crowdfunding, but I don't recommend that. I think you should go out and raise money from angels and VCs, get a market rate, market reality valuation on your deal. If you go crowdfunding first, there's a conception that, well, in the crowdfunding world, you can put anything you want to on it. Well, yes, you can. No, most of those guys aren't looking at the valuation. They're putting in $500. But the moment you step out of that world and try to go to the Reg D or the angel VC world, you're dead. Nobody's going to put money into a deal that's got a $100 million valuation for, $200K of revenue. Yeah, they let you do that in the crowdfunding world, but that's not going to work over here. And you're good luck selling the business, at that rate. Well, that's what you have to think about is, what are the exits going on in your space, and would people pay for a business like that? and they have some fantastic spreadsheet curve they put on this forecast to get there, but there's no way they can actually do that. And so that's why I say go, and angels and VCs are onto that. They know the valuation has to be market reality, and so they don't sign the check until you come down to it. And then later you go raise on the crowdfunding campaign, but with a market reality rate there as well.
So I'm glad you brought that up, because I was going to ask you about GoFundMe and all those ways to raise money, crowdfunding. So you don't recommend doing that?
Well, I don't recommend doing it first, because the thing that most people don't get.
People start there. A lot of people, startups are starting there. Even larger companies, they feel like they need a capital influx to build their business or at the next phase to their company, are starting there.
Right. And the mistake they make is they assume the portal is going to do the work for them. And the portal is going to charge a fee, do the compliance work, put you up there, and then say, you go raise money, not me, you go raise. And then when you get to a certain rate, well, then, hey, we'll add on to it a little bit, and they'll do a mailing and you'll get some nice juice out of it. But most people vastly underestimate the amount of money it takes to do a crowdfunding raise. It's 10 to 15% of the funds raised will have to go into social media marketing and other things to get it up there. And there for a while, the portals were generating maybe 5% of the fundraise. And today they're down to less than 1%, because they got so many deals up there, and the investors are just hit 3 times a day from every which side on deals that they just can't help you as much as they used to in the past. And so the idea is that you need to go and raise money from, if you're going to go spend time raising money from people, you need $50K checks, not $500 checks. Because I've had people come back to me saying, I spent a tremendous amount of time talking to all these people and I got these $500 checks, but if I had gone with angels, I could have gotten 25 and 50. I would have gotten to my goal where I was, because I had to go sell it individually anyway.
And so you have to give the portal a fee too, right? So you bring the marketing people, you got to get the portal a fee.
That's right. There's a fee that goes to the portal as well. But the thing is, if you go and raise money from angels and VCs, you stand up the business and build your network, you can take your network at that point and your customers and start to see if they would help you generate additional. It's just another group to go to that could raise some of it, but it's not going to raise all of it for sure.
Gotcha. And what about going to family and friends to raise money? What's your thoughts on that?
I think you should always go to family and friends. I think that's a great way. They'll support you, and then you return the favor at some point. You support them in whatever way they want. But I think it's a proof of validation. I used to get people coming to me all the time saying, hey, I didn't put any money in. My family didn't put any money in. Nobody bought anything. Nobody back home would invest. How about you? Well, no, if nobody's in this deal, I don't want to be in it either, because there's no validation here. There's no support. On the other hand, they say, I put money in, my family put money in, my local angel group put money in, we sold a little bit. How about you? Well, this is something to think about. Other people are in the deal and you're proving it. And whenever you go to another place to raise funding, you always want to be able to point back that we raise money back home. They believe in me. And so I think you need to show that you have support from people that know you well, because especially in the Bay Area, people have figured out that, if they can't raise money back home, they come to the Bay Area. Okay, well, I'll put money in if your network puts money in. Go get 500K from your local group. I see that a lot. And I think it's a good idea. I think you should do that. You should try to demonstrate support locally.
Shark Tank looks favorably upon that too, because Shark Tank always asks those questions. All right, so you specialize in coaching. What series? So you do Series A. What was the first one?
We do Seed Plus, Series A, Series B mostly. Series
A, Series B. Okay, all right, awesome. And what dollar amount? What's your sweet spot with the ideal candidate, the ideal client for you?
In the seed, they're raising 500 to $1 million, and the Series A, they're raising 1 to 3, 1 to 5 million. And so in there is where I think our investors are normally going to be. We do have people that want to be on the unicorn track, and we just added 0 to all of those numbers. And that's a little bit of a challenge for most angels and most VCs. We know there are some that can do that, but not a lot.
Right. So you do coach some unicorns.
Well, we offer that to them. We get people coming along the curve, and it's a rocket to the moon. And some of them actually are. Some of them do very well. Most don't, but it's the numbers game we always play.
So what's that you apart? What makes you so different than all the other investor coaching companies out there?
We've just been doing it for 20 years, and so we can help people figure out what the issue is, what the problem is, how to work with it. in the very early stage, you really shouldn't be trying to tout your absolute revenue. You should be touting your unit economics story. At unit economics, I'm making a profit here. And I took 5K and I invested it, and I actually ran these ads, and I got these signups, and I got these conversion rates and so forth. So you'd be playing that conversion unit economics story, as opposed to I got 50K of annual revenue so far. Well, 50K doesn't sound like much.
Great point. Yeah, that's a great point.
So, because it's all about validation in the early stage. It's not about revenue. It's not about traction. It's about validating that this thing works. Yeah. And you should do specific tests that prove that, and then make hay with those numbers and say, this, I've proven it works. If you punch more money in, if I punch in $50,000 on those ads, I would get 10 times more revenue out of it. And I've got what I call the repeatable, predictable process. You want to have a funnel saying X number of leads turns into X number of qualified leads, turns to X number of customers, it turns into X number of repeat customers. And I figured out those numbers and those rates. That's what investors are looking for, not looking for just big revenue in the early stage, because most startups don't have big revenue in the early stage. And so, but you want to put that model together as fast as you can and as best you can.
Yeah, Kevin Harrington is really big on that. Because Kevin Harrington has everybody under the sun coming to him to ask him to invest in products. And that's one of the first things he does before he ever says yes. He says, let me take the product. Let me see what I can do with it. And he goes and puts it on Facebook. He creates ads. He creates split tests. He does all of that. And then he comes back and thinks, says if it's a viable product, and if he's willing to invest in it or not.
Right. You have to test it out. An MVP is more than just one unit. It's many things. It's many ways of testing and trying. You should, statistically go through the 5 or 10 distribution channels that make sense and actually test them out at some point to see what's going to perform and how well it performs.
You're talking mostly about product companies. What about like service companies, any type of service businesses, healthcare, manufacturing, any type of any other industries? You mentioned SaaS and you mentioned products, consumer products.
I think you should test those things out as well. You won't have a big software system behind it, but you can build websites. You can build.
Do you coach those industries?
Oh yeah, we do. Yeah, we have all those coming through. We have
You're
SaaS.
agnostic.
Yeah, we're agnostic to it. We work with all the different groups. We even work with the biotech companies. And one of the things we get into now is most of our clients have a vision of selling the data, and we coach them on how you package that up and present that to the investors so you can justify a higher valuation, because it's a bigger TAM. It's another product. It's fungible. There's a lot of great things to like about it. And then put a roadmap slide in there that says, I'm doing a service today, data tomorrow, and AI in the future. And you start to get attachment to growth sectors in the industry. That's one of the key things. You have to attach to something that's growing. And if you've got those growth numbers in your current sales, that's great. Most people don't. Then we need to attach to markets where those numbers exist and be a part of that world at some level. But give yourself credit for selling data and start thinking about that hard, because that is a great secondary sale that you can get out of your service that people are thinking about now, and tools are coming on the market to enable that too.
Yeah, 1,000%. And, we do the same thing. When we get companies that have big databases, like we're selling an app company right now for way above market price, price. And when they have a database with all that content, with all that data on their customers, the first thing we do is up the multiple on that. Those are those proprietary synergies that are going to drive the multiple.
Yeah. So we coach people on, capture your data in clean, well-structured sets from day one and put yourself on a path to do something with it. But you don't do it today. Today, we're just going to get our service up and running. But in 2 years, we should be in a place where we can start to take that data and do something meaningful with it. One of the issues with data is you need a fair amount of it. So it does take some time to build it up. But if it's naturally building up in the background as people use the system, then that is a real moneymaker. And you can double your valuation with that. So those are things we coach people on for sure. In just about every industry, even the biotech industry, we coach people to gather their data and put it into an info system. And for biotech, we're mostly trying to get validation. So we want to sell it to partners in the industry. The big pharma have to pay $100K a year to get access to it. And then you take that to the investor saying, well, they like me so much, they're buying my data. That tells the investor, well, then you have something that the industry really believes in. So I'm going to be looking at this more closely.
Okay. Well, we are at the end here. So do you have any last minute thoughts for these startups and business owners, entrepreneurs trying to raise capital?
I think we covered it all today. I really enjoyed being here and chatting with you about this. It seemed like we have a lot of synergies here with your work and our work as well, but appreciate you having me on today.
I love to further our conversation, talk about how we can plan exit strategies for these Series A's, because the investors want to know what the exit strategy is. As an investor myself, as a partnering with business owners, I don't go into the partnership without knowing what my exit is going to be. I want to know what my exit valuation, because unless I can get an exit for 15, 20, 30 million, I'm not interested. And if I can't do it in 5 years, I'm not interested. So, I think exit strategy is a big part of that for investors.
Absolutely. They should have a vision of where they're going. They may not get there in the same way, but at least they are keeping it in their mind as to what they're planning to do.
Yeah. All right. So how can our listeners get in touch with you if they're interested in your services and your coaching on how to raise capital? Because I really truly believe that anyone trying to raise capital for startups needs a coach. I believe anybody trying to do anything of significance needs a mentor, not just any mentor, but a mentor that's been down the road you want to travel, somebody who's been highly successful, short the learning curve dramatically, and really get you on the path to success much more quickly. I believe in mentors, that everyone should have a mentor, a really successful mentor in their life. So how do they get in touch with you? How? The mentor.
Sure. So our website is 10capital.group. There's no .com on that. It's .coms are taken up years ago. So we're 10capital.group, and you can find me there. Just hit us up, and we're glad to talk to you about your fundraise and how we can help.
Awesome. Well, thank you so much for being on the program, and being on Exit Rich. I think you gave our listeners a lot of golden nuggets, a lot of things that they can implement today, and they can get in touch with you and learn how to start raising capital for their business. So a big thank you, and a big thank you to all of our listeners of Exit Rich. If you like this podcast, which I know you love this podcast, come on. You need to share this with your community, share this with your network, share this with your family and friends. Make sure you subscribe to our podcast, Exit Rich, and we'll see you next week on another episode of Exit Rich. Thank you.
Thanks for listening to the Exit Rich podcast. Don't forget to check out Michelle Seiler Tucker's Build to Sell Blueprint books and Exit Rich, along with more blogs, videos, and resources at exitrichpodcast.com. Be sure to connect with Michelle on Facebook or LinkedIn, and stay tuned for her next episode by subscribing in your favorite podcast player.